say when something positive is going to happen, say a ship is coming with a lot of goodies and or company is doing very well, the bulls take charge and they keep buying because the event is supposed to be very, very positive. The bears know that this is not the time to come in their way. So actually bears don't react on that. The bulls over a period of time grow confident as the event is approaching. So much so that even if there's a small negative event that comes in between, the bulls ignore it. And the prices keep moving upward.
You know, Nimesh, there's always this buzz that market participants should know how to handle events. Now, be it elections, be it corporate announcements, be it, a monetary policy committee meetings, etc. What is your take on this?
There is a specific way in which people actually handle events. Let's take elections and let's go back in time to go 2014. By the end of 2013, Narendra Modi came as a prime ministerial candidate from the BJP side and campaigning started. At that time, the economy was not doing so well. There were many scandals which had come up and you saw there were a lot of political parties making noise about there needs to be a change. The campaign from Modi's side promised a lot of things in terms of good governance and the economic growth, stability, all that. Towards this election results, the Modi wave kind of picked up. Then the election results were fantastic, right? After almost 30 years, India got a government where the ruling party got a majority. And such numbers were not seen in the past 30 years by people. Obviously, then there was a promise that economic growth will be good, your investment climate will be better, macro stability will be there. How much did the market go up on the day of the result? Only 1%. In fact, for the next 2 weeks after the elections, which results came on May 16th, for 2 weeks, the market did not even cross that May 16 high. So what happened during that time? People discount some of these events as they are approaching the events. And the same happens in markets when they look at different events. If something is pre-announced or so, we find many a times that the markets would react in a certain way when that event happens. But when the event actually unfolds as expected by the people, many a times market reverses. It doesn't actually go as per anticipated move. So that happens quite often actually.
Then why does this happen? What can possibly explain this kind of behavior?
So there's an old adage in the market called buy on rumors and sell the news. And you won't believe this is first explained in a book written by De La Vega in 1688. So that far back. And De La Vega actually explains this very beautifully. He classifies the group of investors into bulls and bears, the people who are looking to purchase, people who are looking to short sell in the market. And he says whenever a new event is anticipated, it affects the exchange trades that are happening. And say when something positive is going to happen, say a ship is coming with a lot of goodies and or company is doing very well, the bulls take charge and they keep buying because the event is supposed to be very, very positive. The bears know that this is not the time to come in their way. So actually bears don't react on that. The bulls over a period of time grow confident as the event is approaching. So much so that even if there's a small negative event that comes in between, the bulls ignore it. And the prices keep moving upward. At some point of time, the market has already priced in the good things that this event is going to bring. And once the ship is already in, the dividends are declared and all, bears know that now the next positive event is still far away. So then they start attacking. They start acting on them. The bulls, with nothing to look forward to, start taking profits. So suddenly, the same asset class is abandoned by one set of investors and attacked by the second set of investors. And that actually reverses the trend. So it's quite natural then that in the anticipation of the event, when there's a rumor of something good, the prices move up. And when the news comes in or the event unfolds as expected, the prices start reversing.
Has anyone built on this research in modern times then?
In psychology as well as neurosciences, there have been some experiments and some studies done which talk about this impact. Let's take it piece by piece. Neurosciences, as our brains have over centuries have developed in terms of growing in volume, we developed a part called the prefrontal cortex. This part helps us simulate reality in our mind. So we are able to simulate the happiness a certain event can bring to us. This leads to what is called an impact bias. It is a tendency to overestimate a particular event in our mind. So if something good is going to happen, we start overestimating, oh, we'll feel very good about it and we'll profit from it. And the duration of the feeling will be very, very long. This also leads to another impact, what is called as the positive affect state.
Okay.
Where because of this feeling, we start taking more risks and or we underestimate the risk in this. So we start feeling very positive about it and start taking risks on them. Typically, the crowd also gets involved. When the outcome is very vivid and the payoffs look quite obviously good, it starts a narrative in the crowd and crowd starts participating in purchasing these securities which are positively affected or betting on a positive side of the event. That also starts creating herding. So you are getting a positive impact bias, you're getting herding, you're doing more risk taking because of the positive affect state. So this moves towards the event. Now, by the time the event is reached, what the crowd is anticipating as a benefit from that event is much more or less exhausted. Still, there will be certain new inexperienced investors still coming in after the event also. But overall, the trend starts reversing because there's profit taking coming in. Profit taking starts the reverse cycle. Now, suddenly, your risk taking turns into risk aversion. And this whole stream starts moving on the negative side. So, few studies within neuroscience and psychology do justify the kind of behavior that the crowd does during these pre-announced events which are vivid.
Then does it mean that one has to completely alter the way they look at events entirely?
So there are 3 ways or 3 points that one must consider when you are looking at events. See, if events are pre-announced, the date is given. So for example, corporate earnings numbers or elections or certain policy announcement by either the central bank like the monetary policy announcement or fiscal policy like the budget. In some of these pre-announced events, people start building their expectations before that. So one of the things that it should be pre-announced and there has to be some measurable impact that people can see of that event. 2, full information about the risk of that event should not be available. Okay. And 3rd is there should be a positive price movement or built up of positions towards that event. If these 3 are there, then there is more likely that the event will reverse if the impact is or the announcement is just as expected.
Okay.
Now, when we started with the example of 2014, now between September when the candidature of Modi was announced and the May when the result came in, the market had already moved up 20%. So there was a positive built up. If after the exit polls, there was a sudden shoot up in the market after the numbers that came in from the exit polls. So towards the event, there was a good built up. People knew that this is going to be positive. And that's where on the day of the announcement and a few days later, it saw some reversal.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.